Hello. So after the PayPal video, Palantir reported as well. And it's an interesting report because after the earnings report, the reaction of the stock market was taking the stock at about 22% higher than what it used to be. Now, if you have been a long follower of my channel, a long-term subscriber, or have been lurking around in our Discord channel, you may have seen me talking about how I like Palantir as a business. And one of the core reasons is the fact that they are having like government contracts and they also handle data. And I do think data is very promising for the future in terms of businesses. Businesses who handle data, I think they are going to be sort of like the gold mines of the future. This is why I think a company of that sort, Palantir, does have a bright future. But the problem that I have been seeing with Palantir is that it has been massively overpriced. And you can see that they had an initial sort of like a breakdown from being almost $40 to coming down to like 7 here, and I think it was even lower at some point. You can kind of see it basing here, having a little bit of a base. Now, when stocks do that, this is almost usually, at least, it's like a bullish sign. Because what happens is you have like a decline, maybe a little bit of a base and another decline. And when you are having a long-term base, it's generally considered sort of like a cool down phase where traders are kind of sort of like indecisive whether this is going to be going down, up or down. And some slight positive news, a little bit of a better business, or just plain trading tends to bring the stock up. So it could be an interesting trade here, an interesting like day or swing trade potentially. But what about the long-term play? This is what we're going to examine in the video. An investor who is potentially wanting to take this for a long-term buy, pretty much, and hold it in a portfolio. Now, Palantir soars on earnings beats and prediction of full-year profitability, which is key because the company hasn't been profitable, and this is very important. And you will see that they had a 5 cents adjusted EPS that they reported versus 4 cents adjusted. Now, when you see adjusted, you have to know that, and I have talked about it in multiple videos in the past. When you say adjusted, you basically immediately need to think about the company losing money. So you're maybe asking yourself, so why is this positive then? And that's because they remove expenses. This is what adjusted earnings are. This is like non-GAAP earnings. So they adjust some of the expenses, frankly, to make the report look better. And the official, reason for this is that, they will tell you that they want to be able to sort of like compare results to other businesses of the same industry, for example. They will give you some reasons, which are, some of them are valid, but frankly, the most important reason is basically looking better for investors, frankly. Now, regardless of that, and as long as you understand and know this one, they did still beat in terms of what was expected from analysts. And in terms of revenue, 525 million versus 506, another beat over here in terms of revenue. And the revenue increased 18% year over year, and commercial revenue 26% year over year. The most interesting thing that I read here is the fact that the software company, actually known to work with the government, said its US commercial customer count increased 50% year over year, and that's obviously fantastic here. That's a pretty steep increase here from 103 to 155. That's a pretty steep increase here in terms of their customers. So they are doing really well here in terms of the business. It looks like it's blooming. And their net income, finally, at a GAAP basis, that is not the GAAP that we talked about earlier, is sitting at 17 million. So they are making 17 million. Now, I have again long talked about this. Take a look at their market cap. So their market cap is sitting at 16 billion. So what does that sound to you? A company is making 17 million of net income, that's profit, pretty much, after all the expenses, and they are worth 16 billion. So think about the multiple here. It's huge. It's absolutely huge here. You have to have that in mind, to bear that in mind whenever you are taking investing decisions. And this obviously already tells us that the company is overpriced. Now, to what extent, we're going to see next in the video. Now, the company is set to report between 528 and 5232 million in revenue, and during the second quarter, and between 2.19 and 2.24 billion for the full year. They are doing better, they are growing, which is a fantastic thing to see. But the question is, at what cost? Like, is this kind of company an interesting buy for us, even though it has been dropping a lot? Now, again, as I mentioned earlier, it's potentially a very interesting case for a swing trade. I could definitely see myself taking this one for a swing trade eventually. But what about the long-term trades? Now, the PE ratio is obviously negative. The price to free cash flow is positive after the adjustments. I'm going to explain why later in the video. And the outstanding shares, take a look at this one. This is insane. They have been printing shares like crazy. And that happens in two cases. Actually, mostly one case, but there is also another sort of like side case. The first reason why it happens, and the most important one, is the company is not making money, so they are not turning up profit. And when you are not turning up any profit, you have to somehow make money for the business to operate. And what do? You either borrow money or you issue shares and get money from shareholders. The second one, the latter, is actually cheaper, and this is what companies tend to go for at least for a long while, till they resort to pretty much lending. Both are kind of bad for investors now, for different reasons, of course, and I have talked about it in the past. But this is the most important reason. The other important reason which can happen at times is the stock is very expensive. So as you'll see here, the stock was very expensive. So this is sort of like both reasons are valid here. And when the stock is very expensive, the board needs to take the decision of issuing shares. That's the proper decision to take, because they do know that the stock is expensive and they can make tons of money. So why would they not do that? Now, as an investor, it's not the best, but the board should be thinking about the future investor, not the current investor, frankly. And it may sound a little bit weird, but this is why you should be doing your own due diligence, because if you have done your own due diligence, you may not have decided to buy here when the company was actually issuing shares, is the thing. And this is what I'm trying to sort of like, I should say, low-key teach with my videos here. Hopefully I can help a little bit. Now, the revenue growth of the company is sitting at 220%, so they have been growing tremendously, and this is one of the core reasons why you would like this company. But again, you have to account for the cost. And they don't have debt, you know why? Because they're issuing shares, so there's no need to take up any debt. Now, the financial statements of the company will tell you that the company has been growing tremendously, which is nice to see, at a very, very nice pace, starting from almost zero here. But the net income has been going lower and lower till it becomes a little bit better now, and we're getting to profitability. So kind of having a nice trajectory here. So I like to see that for sure. Now the balance sheet of the company, you will see it's positive from negative to very positive. Guess why? Additional paid in capital. What does it mean? This means that they issued shares. So they issued shares and they increased their capital here. Additional paid in capital is how we call this in the balance sheet. And so this is basically issued shares and the money that they made out of the shares. And the cash flow statement, and I told you earlier that the net income is negative, yet we're seeing positive operating cash flow and positive free cash flow in some cases. And the reason for this is, the well-known thing that I have talked about in many videos, stock-based compensation and sometimes depreciation amortization. In the case of Netflix, for instance, you would see that as a high value. But stock-based compensation here to be expected, because these California companies, these sort of like Bay Area companies, pay tons of stock-based compensation to employees. And guess what? Stock is not cash. And since it's not cash, it needs to be added back to the cash flow statement. It's a non-cash expense. It needs to be added back for the adjustments. You do see it as an expense here with the net income, but it's get added back on our operating cash flow. In our operating cash flow, and this is why you're looking at positive free cash flow, but you need to remember that this comes from negative net income. Now, the elephant in the room, what about the actual price to pay for the company? Let's take a look at our stock evaluator here and decide whether we want to be buying this one. The company will probably continue to grow at a pretty solid pace here, so I'm going to try relatively high values that do make sense for a company of this sort, like 18%, 22, let's just say 26. I will go a little bit too high here. 22 and 26 may be a little bit too high. Potentially achievable. I mean, it's still within the averages that the company has been achieving. And I'll tell you a little bit later why I'm trying these values. Now, the net income margins that I'm going to be using, remember the company is not profitable, and this is a problem. It's difficult to deduce what the net income of the company is going to be when they become profitable, because typically you will see it start creeping up higher and higher and higher. Remember, this is a software company, so we do expect high net incomes when they become profitable. And so I do fully expect that they will be sitting near the 20% raise, 20% area. So I will go a little bit lower, of course, because I cannot just directly go to 20% and from today to the next year. This is not going to be happening. So what I typically do in such situations is I try to assume that the company is going to be marginally profitable. So I pretty much always do something like 1%, 3%, and 5%, which again, remember, it's probably not going to be the norm, but it's very much likely what is going to be happening in the next 5 years. And remember, this is a discounted cash flow model for the next 5 years. So 135 is basically something that we could see could be better though. So again, this is the whole purpose of using a discounted cash flow model and obviously gaining access to the tool, which all our patrons have. And if you're interested, you can find a link in the description box below this video and become one and try your own projections here. So I'm gonna be using also 80, 90, and 100 for the free cash flow margins here, which I think is it's actually very typical for companies. You could even try 100 for all of these and basically say that the free cash flow is turning to net income at the same rate pretty much. But when I hit this calculate button here, you will see that we are very, very far from the current price of about $9 right now, because the stock is up 20% and more. And you would expect that. Is based on what we have talked about so far, the company is very, very expensive. Now, when they actually make what I think is going to be their normal net income margins, and it could be even more in some situations, then it gives off sort of like the $4, $5 vibe. If that happens, when that happens. Now that hasn't happened yet, is a problem. So if we're looking at this today, then it may be much more interesting at 7. Now again, it's at 9. But as it is right now, I'm seeing this company and it's still very, very expensive. So even though they have been dropping off a cliff, the stock price has been going down and down and down. I do like it for a swing trade. I'm not a huge fan for a long-term trade though. So I could definitely see myself trading this for like 3 months, 4 months, like having a stop loss, potentially exiting if it goes to 5 or something. But for a long-term trade, I would want to be getting it at a much lower price. And if I buy it right now, I'm basically betting on people, not knowing what they are trading, pretty much, not knowing what they are buying here. And I'm gonna be asking for somebody to buy the company for no reason at a higher price, frankly. And I don't like to be making such trades at least for a long-term portfolio. If it's a swing trade, it's different, because then we're trading tickers and not companies, frankly. But in this case, I think I will avoid Palantir, even though they look like they are doing better. They are still super expensive, so I will be avoiding this one for now. And I'd love to hear your opinion. Thanks for watching, guys. Bye bye.